Good evening. It is November 22nd and it is 6:22 p.m. Eastern Time. This is a weekly update of the stock market, and I will probably only do a phone update Monday morning unless the market's so quiet that maybe I should delay it to later today or just wait for Tuesday when we'll do another video update probably. But tonight I thought we'd do a video update. I probably will throw in some really short-term stuff as well, rather than like the weekly version when we normally do just long-term or intermediate term. But let's start out with the intermediate as if we were doing a normal weekly. Okay, so what we have is the stock market relative to the S&P 500 bottomed in March 23rd. We had a buy signal by March 25th as a long-term bottom. The market has rallied to record highs. We're in a long-term bull market to 2028 to 2032 when we anticipate 20 to 50% drop in the stock market and a recession. Along the way, we should have minor long-term business cycles that can provide 3 to maybe as many as 5 significant buy the dip opportunities when the market could be down 10 or 15%, say 7 to 15%, something like that, and possibly some kind of scare that drops it as much as 20%. Those 3 to 5 will fit in a total of 16 to 25 or 24 buy opportunities. It's possible we'll have to allow a little more as if the market decides to extend all the way to 2031 before collapsing. Okay. Now, those buy opportunities, besides those 3 to 4 that I mentioned, 3 to 5, those would be level ones. And we're kind of ignoring the level twos, which is the second most important buy during the year. The level 1 buy probably will show up 2 to 3 times a year. Add some level 2 and you can get up to a total of 4 to 6 buy opportunities during a year. We have a level 2 buy opportunity coming up. And so you can trade it by itself as a level 2 or a level 2, level 1 combination. For the long-termer, you could use it as an intermediate, incremental purchase again, even though I tend to stress of trying to only buy level 1s, but sometimes the bull market is so strong that if you wait to buy every level 1s, you'll miss out some level 2s that were actually better deals than some of the level 1s along the way. So we believe the market's coming down to level 2, and I'm pleased to see the market off a little bit tonight, a little bit soft for the starting, because this is the first week to start looking for the level 2, but it ought to go down more than this, okay? Longer, I should say. We have weekly indicators overbought and starting to roll over towards a potential sell signal. And we have the coronavirus exploding towards 200,000 cases per day for this year, record high. And it may continue to do so for the next several weeks, even though by December 18th it should top for a particular wave. And the transition from the White House may speed up here a little bit now. But I question if they're going to get all that much accomplished before year end. And the White House, or I should say the Treasury, has been fighting with the Federal Reserve, which some say that's always been the case, but they kept it to themselves. They kept it quiet. Now their dirty laundry has been aired. Okay. So these are things that can bother the market and pull the market down. But if any of those things improve, I want to be the lookout that maybe this level 2 drop won't work, because what the model and all the technical analysis and what I think fundamental valuations suggest this market ought to pull back to near 3,400. I do not believe it ought to pull back to the October, early November low with the election. I do not believe it should pull back to 3,250. It could, as long as it doesn't violate the September low. I would not be too concerned. So my guess is we're not going to see 3250. We're going to find support in the 3300s to 3400s. You can run your Fibonacci retracements. You can run a 50% retracement of this amount and of this amount. You might have some retracements you could use of this amount, but again, I think I'd focus on things that are above 3250 and not record high. Okay. Now, the problem is this market does not have to bottom out the week of December 14th, meaning it bottoms out ahead of the coming electoral college vote. The model is suggesting from a level 2 bottom, the stock market should rally into a level 2 top in January there should be another pullback for level 2 and level 1 bottoms January, Feb, and that could be a larger decline than what we're going to see right now. It may be as large a decline as seen in September or larger, so it could be a bit more of a shock, okay? Once that in place, however, the market should be a record high by February, March, April for a level 1 top. So the way the sequence of these level 1, level 2s are, we can't seem to get to a pure level 1 top to a level 1 bottom that could be the most volatile decline and could be the most significant scare news-wise and also the most significant change in fundamentals. To me, that kind of scenario, that kind of synchronization, the sequence, is probably more reflective or would relate more to a bull market than a bear market, which suits me fine because I'm long-term bullish. So anyway, I want to see some more downside this week, even though historically I always thought the stock market rallies into Thanksgiving and then pulls back after Thanksgiving for some December year-end tax selling. This year we may get something more serious in the news with all the politics and the virus scare. And it is possible the economy is rolling over now. All I can tell you is I'm probably don't have true high frequency fundamentals here. I have to wait a little bit to find them and locate them. All I can tell you is the economy up to recently, I think, has done quite well. All right. So frankly, I think most of the selling that should have occurred now into this level 2 bottom actually occurred going into the election. And I just don't think they need to sell as much. And I think everybody is really bullish for next year. I think they're bullish for the Biden term. And normally the economy does better under the Democrats than the Republicans when you're looking at GDP. Now, of course, there's many other facets and perspectives of an economy, so I fully understand why some people would say, no, I think the economy does great, or at least I do great, even though the GDP isn't doing great. Yes, you can be that way, okay? And I used to think the stock market only does good under the Republicans. I think history's showing that's not the case. It can swing either way. So this is going to be interesting. Now, that's where we're at for this move down. Let's quickly move over. I want to do some time to touch base on some foreign markets, but let's move over to the daily chart. And here we have a level 3 bottom. Now we're switching from those level 2, level 1s that are your largest trends during the year, most important. That's where most of the money is pushing the market. Inside of that, you get fluctuations, twists and turns, and the most important twist and turn is a level 3. And that bottomed 11.12 to 11.13, still debating which day it is, and it really doesn't matter. In theory, this week is the first opportunity for a level 3 bottom. I'm not convinced that it can actually bottom Monday or Tuesday. In fact, I think this is an error. Probably it's because of the way these quoting charts deal with weekends. I think you want to allow a bottom as late as Wednesday for a level 3 and the first opportunity for a level 2. Now, what do I mean by first opportunity? Remember, I told you of more in 1 week. We could have this kind of scenario that, yes, it bottoms for level 2 and then it zigzags with level 3s all the way up into January for level 2. Okay? Now, if the virus is really going to cause an economic setback, and if the Fed and Congress could not do any more, this entire sequence could mean the same in terms of amount of time, duration, the number of zigzags, but it could actually have a downward bias. So something can go wrong here. We have to keep our mind on that. But my best guess is the L2 bottoms here, in other words, later this week on and early next, and we get a little bit of a blip up for just a few days, and then it comes back, and if it goes to a new low, the model's going to say, whoops, no level 2 here, just a level 3. Move the level 2 over to the next level 3. But then it's going to say, now that's the latest. And then we'll start that sequence moving higher. Hopefully, as long as we don't get any true fundamental damage where people say, gosh, this is going to be a mess for a while. And there are some big major banks saying, we've got problems coming. We're going to see some poor economic data by early next year, say January, February, perhaps for the first quarter. But they're also bullish to very bullish for next year and during the Biden term. Okay. Now the daily indicators are stochastic is coming down near oversold. So that's a warning the model is doing the correct thing of looking for a level 3 bottom and perhaps the first level 2 bottom opportunity. Okay, so we have some technical supporting what the model's looking at when the model's looking at more than just technical. I like that. All right. Now let's zoom in for what we got for level 4s, and I don't think I'll bother with the intraday chart here. Basic, a level 4 bottom is due today, okay, or tonight on and through tomorrow, and the market at least ought to be up by Tuesday. Now, the market topped Friday sooner than it should have for a level 4. That's a bit concerning that this could be sloppy the next few days, and it might have something to do with the holiday, people trying to not trade if they can help it, okay, taking time off. But usually the professional trader's still staring at his phone while he's trying to have fun with family and whatever, and he can still take action here. And of course, the computers can be watching things for them, and there can always be somebody on board on the desk to manage things. So we could get some increasing volatility instead of a boring time just because you lose liquidity, and it can either relate to boring or more volatile times. I'm going to say it didn't work for a top, and I'm not going to worry about it snapping back one last time. But if you see a sudden surge overnight and early tomorrow or something like that, I'd be concerned it's just going right back down. All it was doing was trying to do one last chance of placing a proper level 4 top. So my guess is look for a level 4 bottom late Monday, on and early Tuesday, some kind of a bounce by Tuesday, okay? And I think the 5-day average is going to work at nearby resistance, because I think it's going to take a bit longer to actually put in this level 3, level 2 bottom, and I'm hopeful it gives us a little something under, say, the 35 mark. If it violates, where is it, 35.13 for the March S&P 500 futures, we're going to have some critical point projections generated that suggest it could drop as low as 33.61. I'm not saying it will go that low, but we have to consider a chance. All right, so that's some of the very short-term stuff, plus the short-term, and you've heard of the intermediate, and I've given you the long-term update. We're in a bull market, but nothing moves in a straight line. You have twists and turns, and sometimes they can be 10, 15, 20% down, and then up 10, 15, 20, 30%, okay? Then you find far more often there's smaller fluctuations of 7, 10%. Still many more fluctuations, 3 to 5%. And then almost day to day, it's 1 to 2% these days, okay? All of those can be labeled and tracked by the model, and then the model warns when you're ready to jump from, say, a small move to a very large move, or perhaps swinging back to small moves. Okay, enough on the stock market. As far as the U.S. stock market, let's touch base on some of the outside markets before looking at some global markets. So here's the 10-year note, and it's trying to move higher tonight, although my quote screen says, no, okay, it's moving higher. Not much going on. Range bound, and what I love with these candlesticks, look at the open-close spread just stuck in a range, but look at the lows and the highs, the candles, the wicks of the candles, kind of volatile. This is where the real business was being done, in my opinion. Everything else isn't noise, because according to models, no such thing as noise. We can label every single fluctuation down to a second. There is no noise, okay? But when you try to deal with a market, it's acceptable to say, okay, I'm trying to focus on this, and you know what? Everything's shorter term is noise, okay? I get that. All right. Any rate, bonds should pop a little into December. I say little because I don't think it's going to have anything to do with a seriously dropping stock market. I could be wrong. I don't know as I have enough fundamental, nor technical, nor core model-based evidence or analysis. The indicator's trying to move up, trying to make a run. Ultimately, I think early next year we'll still see lower bond prices, higher interest rates, and more talk of higher inflation. This is the dollar index. Doesn't seem to be doing too much tonight. It's off just a couple of ticks, 3 ticks, okay? Was off last week, but it was an inside week, so they're going to watch the low and high of 2 weeks ago for the dollar index, trade above 93.20, trade below 92.13. They're going to run with it. They're going to run in that direction. They're going to try to run in that direction. What bothers me is the weekly stochastic is oversold. The model's been looking for a level 2 bottom, and it's getting late. So I'm getting nervous it's wrong and it just keeps going lower and early next week. But the thing is, a level 1 top is due along with level 2 top. It should bounce. I say it won't bounce any higher than 94, and I think it can bounce to 94 and not necessarily relate to a sizable drop in the stock market or economic woes or worries. They could bounce on worries, but I'm not so sure the rest of the markets will be all that nuts about it. And I think ultimately early next year, the dollar goes lower as it dials in higher interest rates, which would normally strengthen the dollar. But the reason it's going to dial in higher interest rates is it's got a primary focus on higher inflation. And the dollar normally goes lower with higher inflation. All right, here's gold. Very quiet. It's off a little bit tonight, but it looks of it. Almost an inside week last week. Really couldn't make up its mind. It's getting way too late for level 2 bottom. I would really appreciate gold turning up this week into next because it is due for a top in December, right along with bond prices and right along with the dollar. And so there ought to be something to make it pop. But what I'm warning you is I'm not so sure this has to have anything to do with the stock market. And I don't think it has to be a sign of a bearish stock market. So we'll keep an eye on gold. I fully understand why some are getting nervous here, thinking, this is just resting, it's going to break lower. I get it. And I still will be a long-term bull in gold, but I'm going to have to backpedal and say this could be a correction or a consolidation that's going to last a while before it gets bullish. Ideally, it'll give us a little bit of pop in December, and then we're going to have to be concerned. Yes, it could be down in early next year. I think the gold market needs more evidence of inflation, and I think it needs evidence we're conquering the virus so we have a better economy so that inflation can actually work. Right, the moment gold is saying we have inflation all right, but it's the wrong kind of inflation. We don't necessarily have a good economy yet, even though it's coming back. Now, in my opinion, the economy is much better. Now, here's Bitcoin, and it looks like we missed our opportunity for a level 1 top. It's due for a level 1 bottom now, so any sharp stab could suddenly be erased and it just marches higher anyways. And I'm wondering, was this actually a running correction right in here? And we've seen the level 1 level tops and bottoms. It doesn't matter. And this thing is just going to work higher for months. Very, very bullish. Is not correlating with gold very well at all. So what's that? That concerns me. Something's wrong there. We got a fundamental disconnect. It is not in line with the US dollar really at all. So what's up with that? And a lot of people are saying, the Bitcoin people are telling us something different, of something that's either going really right or really wrong. Which is it? Now, it's extremely overbought, so we're going to get a correction someday, but I'm also concerned all it does is resets, goes up still higher later. So yes, I'm bullish Bitcoin, but gosh, I don't trust the long-term scenarios a lot of people talk. Bitcoin could drop 90% for all I care. All right, let's go to crude oil. Now, this is looking better for me. We got crude oil hanging in here tonight compared to prior close. It is getting overbought in a weekly stochastic, but that is wide enough spread to suggest chance for lingering upside momentum. So I'm a bit concerned that this is actually a level 1 bottom, top, level 2 bottom. They both occurred earliest allowed. Missed it if I was trying to be aggressively timing, and I was not. This is kind of just an extra thing I throw in with the service. But if this is correct, this market's rallying into January. Okay? Now, if it's not correct, then oil should be topping now, set back, and if it ever takes out this low before bottom due in sometime late January on into mid-Feb, it should go even still lower, and that could be a sign of a poor economy, issues from the virus hurting us, and whatnot. It could be more than just microeconomics inside the oil market when there's all the oil you want. Okay? All right, so that's some of those markets. Let's move over to some global stocks. Here's China, the Shanghai Composite Index, and I believe it's in a long-term bull market into late 2021 to early 2022, and that may be revised a few times. Now, the problem is I don't think it's actually put in a long-term bottom, which may not even show up to mid-next year. Okay, and these are minor long-term bottoms, by the way. But I'm concerned the top is more important. There's something that's not synchronized to a nice flow here. And I think when you try to come up with a balance of that, a net balance, a bias, a summary, it's actually bullish longer than it is bearish. I'll go with it. And I think you just recently seen level 1 bottom and level 2 bottoms in the Shanghai China Index. So I'm bullish Shanghai. I think it's going to 4,000 next year. Okay. But I don't know as I have all the fundamentals to back it up, but I like what I'm seeing in some of those economic indicators and the recovery from, okay, the virus and the dealings with the US on China. And now we got Biden, and I'm not so sure. I almost think some in China would prefer to deal with Trump, actually. But I think at the same time, they feel like things can calm down and maybe we can get better dealings, both sides, work it through. I think at least global investors are saying they want to own some China stocks. Things are going to get better. It's going to work out okay. Let's swing over to Europe, or not. Hold on a second. I need a different chart of that. Okay, this is the long-term chart of the Nikkei index. And someday I got to get caught up on South Korea because our daughter's over there. She says their economy's booming. They're doing a fantastic job of fighting the virus, and the U.S. just looks silly and far behind on the virus. And but she says they're doing well enough. She says they can have a setback like anybody at any time, but she thinks they'll get over it quickly. And the economy's doing well. She's made some good money on the currency side of things, apparently. At any rate, this index Nikkei has gone to a new high. And even though I'm showing a strange forecast that could allow for a long-term top now, I really want to get it more in line with the U.S. markets, and so we should stretch this out. Or actually, we should use February, just like the U.S. for a 3-year. And this suggests this index, like the U.S., can rally into late 2021 for that particular minor long-term. I'll have to reevaluate whether I want to say the Nikkei is bullish for this decade. I think a lot of global stocks follow the same cycles, but it can be different timing. Now let's swing over to Europe. Sorry, let's do one more. This is the Sensex for India. And look at that beautiful uptrend, bull market, and it's likely not to peak for that particular minor long-term business cycle to late next year. Here's the French CAC index, and I think it's bullish into late next year. And I've been wanting to watch this rain consolidation. They broke it down, turned out to be a fake out, and quite often when it's a fake out and goes the other way, it's like they got to double down, okay? They lost on their down bet, they buy it back, they reverse, but then they buy even more. And look at that move. Fantastic move. They really like the Biden win. Okay, and I'm with them in the sense of it looks like a bull market here to May. I think it's going higher into late next year, regardless of what's going on with Biden. Very good support for France. Now let's see if we can take a look at the DAX. All right, the DAX is actually dragging its feet to the CAC on, say, a near-term perspective, but then you zoom out and you can see it's always, generally, it's a bit firmer, stronger than France. Okay, so I like this. I think we got a level 1 bottom in place here. Okay, and I think the trend is up. And I think the German market is going higher into late next year. I don't think I'll show Spain this time around. And let's go to the global Dow. Give you a general idea of the world. Took out resistance. Caught fire. Taking out resistance here, knocking on the door of prior record highs, minor long-term business cycle low in place, and that may even be a 9-year just like the U.S., because this is primarily driven by the U.S., I suspect. And look at this. This is now stronger than U.S. market. So we got the U.S. market holding its ground, and now we're waking up Europe primarily, and India, and apparently Asia's doing well. The whole world's starting to go. We've seen a recession for the world from 2018 into 2020, and now we're going to see net growth probably for this decade, something similar on a time span to the U.S. Now here's a bank index in the U.S., and I've been concerned of this consolidation. It was dragging its feet. It was staying way behind the U.S. stock market, but this month we see an explosion, and I've called a long-term bottom. It's finally catching up with the U.S. stock market. This means our banks should be more stable. They should be able to do more business here. They should be able to breathe a little easier. Their profits can return. Investors are feeling more comfortable with their forecast for banks. I think that's good for the U.S. Okay, even though interest rates are going to rise, I think they're going to figure out how to make a buck out of that. Okay, now on the Russell 2000 in the U.S., finally a record high, finally catching up. Really like that. I showed you a ratio of that. And I said if it goes above 0.49 and it just exploded past it, I said, I think that's some kind of long-term buy signal in the ratio, suggesting the Russell 2000 can outperform the S&P 500 for at least a few years here. I can't tell you if it can do that all decade. I kind of doubt it. But I really am pleased to see the Russell 2000 wake up, because I think the Russell 2000 reflects the small stocks that obviously have a closer connection to Main Street, small business, the mom and pop. I think this is a better clue for our economy than the S&P 500, the NASDAQ, and even the Dow Jones, those big companies. Okay, so I'm hopeful this is a sign investors are now seeing they can start broadening out their investment strategies. Plus, we hear all the talk of them moving out of growth into value. I think these are positive things in the next phase of a very long-term bull market. Okay, so that's what I've got for that wrap up, and I do not recall if I did any more updates on a very long-term basis. I've got these lines with a general idea of how it should fluctuate over the next couple of years or something, and there's more upside here in the S&P 500. I think it's on its way to 4,000 over time. I'm trying to see what else I wanted to look at here, because I have many different long-term charts trying to run scenarios, and I just hopefully got the better one to show you. At any rate, here is so here's some of our upside objectives going into late 2021, maybe as high as near 4,500 for the S&P 500, but it could stall out, chop, and be a slow grind higher. But we also see a drop, quite possibly back to 3,251 or something like that, late 2021 to early 2022, and all of this will just be significant twists and turns within a bull market this decade that, for all I know, has yet another 150, maybe 200% upside this decade. And then you use my long-term strategy tactic, you can double that to 200 to 300 to 400% yet left in this decade. I think that's very impressive. So at any rate, yes, long-term bullish, major long-term bullish, minor long-term bullish as well for late into election year. Lots and twists and turns along the way from those level 2, level 1s, okay? And we're due for one of those twists and turns right now as we speak, okay? I'm trying to do a quick review here without forgetting everything. So again, I'd appreciate seeing some selling here this week. Would like to see it actually over this month, but we have to give it into early next year. Oh, I did want to touch base on the VIX, because I've been a bit of a slacker on it, and it's changed its synchronization a little bit on me. At any rate, the model's saying actually things are tracking well. It just didn't correlate that well to the stock market. I thought it's down already, and it's saying the VIX shouldn't bottom for at least another 2 weeks, maybe 5 weeks. Well, if the VIX can go that lower that long, I realize it could be just a slow, grudging decline, but it ought to reflect a greater chance for a higher stock market than lower. It does leave the door open, however, for a sideways stock market, so that keep that in mind. And it does warn by January, February, we should see a spike in the VIX. Well, guess what? We just said, give us this bottom here. The stock market goes higher into January, but sometime January, Feb, it's going to pull back for a level 2, and lo and behold, this will be a level 2, it'll be a level 1 top due for the VIX. Or no, it will be a level 2, okay? So my gut feeling is we have an opportunity for December to actually finish better than I would have thought several weeks ago. If we can just pull this back, consolidate a little bit. Now, as a backup, if it starts going to a new record high, we need to just throw in the towel saying, somewheres we missed the level 2, it was a non-event, didn't work. I'll blame it on the overreaction back in the election. It kind of threw things off a bit. And I'll just have to be bullish anyways, folks. But right at the moment, I want to go shopping, but I'm out of the market, except for my very long-term position, which did strike 100% gain. I haven't checked on it, but it's probably back to 90% or lower or something now. Probably not. It's probably around 90%. But I'm hopeful it pulls back some, just so for all my other accounts and portfolio and strategies, I can get some stocks bought. Manage your risk relative to others, and if I see a reason, I'll give you an update, or maybe I'll just give you a phone update anyways. That would be an audio update, I mean, from my phone. Thank you for being a subscriber, and please pass the word on to others. Manage your risk relative to others. Wear a mask.